In the spring of 1865, a Confederate widow in Richmond, Virginia, sat down to count her savings. She had $11,000 in Confederate currency, fortune, or what had been a fortune. What had bought her that morning was close to nothing. The government that had issued every one of those notes had ceased to exist. The army that had guaranteed the currency had surrendered. The promise printed on each bill, backed by the faith and credit of the Confederate States of America, had become, in the space of a few weeks, a historical artifact. She had not been reckless. She had not speculated. She had trusted the institutions of her world with everything she had. Institutions dissolved. The savings dissolved with them. Right now, 73 million Americans are trusting the institutions of their world with their retirement. The question nobody is asking out loud, but that history has been screaming for centuries, is simple. What happens when the institution can no longer keep the promise? August 14, 1935, Franklin Roosevelt signs the Social Security Act into law. The crowd applauds. The cameras roll. A nation broken by 6 years of depression allows itself cautiously to feel something like hope. The promise is elegant. Workers contribute. Retirees receive. The government administers. Dignity in old age, guaranteed, permanent, American. What nobody said in the applause of that afternoon was the single mathematical condition on which the entire system depended. Not political will, not economic growth, not good governance, something simpler and more fragile than any of those. Population growth? Social Security is not a savings program. Your contributions do not sit in an account with your name on it. The money you pay in today goes out today, directly to current retirees. The system functions because there are always more workers than retirees. When that ratio holds, the pyramid stands. When it inverts, the pyramid does what all inverted pyramids do. In 1950, there were 16 workers per retiree. The math was effortless. By 2024, there were 2.7. By 2035. The Social Security Administration's own actuaries project 2.1, 2 people holding up the weight of 1. Those 2 people are also carrying mortgages, raising children, and unlike the generations before them, carrying student debt loads that previous retirees never faced. This is not a political opinion. It is arithmetic. The trust fund was supposed to be the safety net beneath the safety net. A reserve of accumulated surpluses, money set aside during the decades when the system was flush. Held in trust for the years when it would be needed, held in trust. There is a phrase worth examining. When Social Security ran surpluses through the 1980s and 1990s, that money was loaned to the federal government in exchange for treasury bonds. The government spent the money on wars, on tax cuts, on the 10,000 other demands of federal spending. What remained in the trust fund was a filing cabinet of IOUs, promises from the Treasury to repay money it had already spent. This mechanism has a historical precedent that should give every American pause. In the final decade of the Dutch East India Company, the VOC, once the most powerful commercial enterprise on earth, company administrators continued issuing pension payments to retired employees from funds that did not exist in any meaningful sense. The pensions were recorded. The ledgers were maintained. The payments were made drawn against future revenues that the company had already borrowed against, and spent, and borrowed against again. When the VOC was formally dissolved in 1799, those pension obligations dissolved with it. Retired VOC employees who had given decades of service to an institution they believed permanent discovered that the institution's promises were only as durable as its solvency. The Social Security Trust Fund will be depleted by 2033 under current projections. When it is exhausted, the law mandates an automatic 23% cut to every benefit check in America. Not a proposal, not a debate. Statutory consequence written into the law, waiting quietly for the mathematics to catch up with it. The Irish Poor Law of 1838 created a similar structure, a network of workhouses funded by local taxation, designed to provide a social floor beneath the most vulnerable. It worked marginally when the population it served was stable. When the famine arrived and the dependent population overwhelmed the contributor base, the system did not adjust gradually. It collapsed suddenly, brutally, leaving the people it had promised to protect with nothing but the knowledge that the promise had been made. A promise made by an institution that cannot keep it is not a promise. It is a deferral of catastrophe. And deferrals compound? There is a number that should redefine how every American thinks about their financial future. Not $36 trillion, though that is the national debt, and it is staggering. The number is $1.1 trillion. That is what the United States paid in 2020 for simply to service the interest on debt it has already accumulated. Not to build, not to defend, not to educate or heal or maintain, simply to pay the cost of previous borrowing. For the first time in American history, interest on the national debt exceeded the defense budget. It exceeded Medicare. It exceeded every other single line item in the federal accounts. And it is growing. By 2028, independent projections place annual interest costs at between $1.60 and $1.9 trillion. By 2034, potentially $2.4 trillion. Under normal economic conditions with no recession, no emergency spending, no new crisis. These are baseline numbers. The mechanism that produces these numbers has a name: the debt spiral.
Ow.
And it follows a sequence that history has documented with devastating consistency. In 1875, the Ottoman Empire reached a moment that its finance ministers had known was coming for years, but had lacked the political courage to address. Debt service consumed more than half of all imperial revenue. The empire could not pay its soldiers. It could not honor its obligations to creditors. It formally defaulted on its sovereign debt in October of that year. What followed was not immediate collapse, it was something more insidious. In 1881, the Ottoman Public Debt Administration was established, an organization run not by Ottoman officials but by foreign creditors, given direct control over specific Ottoman tax revenues to ensure debt repayment. The empire had not merely gone bankrupt. It had surrendered financial sovereignty to the institutions it owed money to. The Ottoman state continued to exist for another 40 years. But the decisions that mattered most, where the money went, what could be spent, which obligations would be honored, were made not in Constantinople but in the offices of European bondholders. When a nation's debt reaches the point where its creditors effectively govern its finances, the citizens of that nation have lost something more fundamental than money. They have lost the ability of their democracy to determine its own priorities. The doom loop that connects America's debt spiral to the death of Social Security is mechanical, not theoretical. The trust fund exhausts in 2033, possibly earlier under recessionary conditions. At that point, Treasury must borrow additional hundreds of billions per year to cover Social Security shortfalls. On top of the $2+ trillion it already borrows annually, more Treasury bonds means higher yields. Higher yields mean higher interest costs. Higher interest costs mean a wider deficit. A wider deficit means more bonds. Higher yields. The loop has no clean exit. History's most extreme illustration of where this loop terminates came not from a developing economy, but from post-World War to Hungary. In 1946, Hungary was experiencing the most severe hyperinflation ever recorded in human history. Prices were doubling every 15 hours. The government issued a 100 quintillion peng note, a number so large it had to be written in scientific notation. Hungarian retirees who had saved in peng, who had lived carefully, worked for decades, trusted the state, found that their lifetime savings would not purchase a meal. The debt spiral had consumed the currency. The currency had consumed the savings. Savings had consumed the future. Hungary's experience was extreme in its speed. What made it possible was ordinary in its structure. A government that had promised more than it could deliver, had borrowed to cover the gap, and had eventually reached the point where the only remaining tool was the printing press. The United States is not Hungary in 1946, but the direction of the arrow is the same. On the afternoon of August 15, 1971, President Nixon appeared on American television and announced that the United States would no longer convert dollars to gold at the fixed rate established at Bretton Woods in 1944. He called it a temporary measure. It has been 54 years. What Nixon ended that Sunday evening was the last formal constraint on American monetary expansion, the last mechanism that required the United States government to maintain some relationship between the dollars it issued and a real, finite physical asset. After 1971, the dollar was backed by nothing except confidence. The full faith and credit of the United States government the collective belief of every nation on earth that America's word was good. For 50 years, that confidence held. It held because the American economy was the world's largest and most dynamic, because American institutions were the world's most stable, because there was no obvious alternative. All of those conditions are now under pressure simultaneously. The dollar's share of global central bank reserves has fallen from 71% in 2000 to approximately 57% in 2025. That decline is not uniform and not rapid, but it is consistent. And in reserve currency dynamics, consistency over decades becomes structural. The BRICS nations, Brazil, Russia, India, China, South Africa, their expanding membership, have made explicit the intention to reduce dollar dependency in trade settlement. Saudi Arabia has discussed yuan-denominated oil contracts. Central banks globally purchased gold in 2022 and 2023 at rates not seen since 1967. These are not marginal events. They are the early measurable signals of a confidence arrangement beginning to loosen. Venezuela's experience shows what happens when a resource-rich nation with a nominally powerful currency loses the confidence that underpins it. In 2012, Venezuela's bolívar was the official currency of a country sitting on the world's largest proven oil reserves. By 2018, annual inflation had reached 1 million%. By 2019, the government was issuing a sovereign bolívar, a redenominated currency that stripped 5 zeros from the old one in an attempt to restore the psychological fiction of monetary stability. Venezuelan retirees who had spent careers in the state oil company, contributing to pension funds denominated in bolívars, discovered that those funds had been inflated into irrelevance. The oil was still in the ground. The currency was worthless. The pensions were paid technically, faithfully, on schedule, in money that could not buy a week's groceries. The mechanism was not unique to Venezuela. It is the mechanism of every government that resolves the gap between what it has promised and what it can deliver through monetary expansion rather than structural reform. For the United States, the Federal Reserve's impossible position makes this mechanism the path of least resistance. Raise interest rates to defend the dollar. The cost of servicing $36 trillion in national debt becomes genuinely unsustainable. Every percentage point adds approximately $360 billion per year to the interest bill. Lower interest rates to ease the debt burden, and inflation reaccelerates, eroding the real purchasing power of every dollar-denominated savings account. Every fixed income, every Social Security check. There's no combination of monetary policy tools that resolves this contradiction cleanly. There is only the question of who bears the cost. History is consistent about the answer. The people who bear it are not the ones who created the problem. They are the ones who trusted the system, who saved in the currency, who believed in the institutions, who assumed that the rules they played by would remain the rules. The dollar will not collapse overnight. Reserve currencies rarely do. Decline the way the British pound declined after Bretton Woods gradually. Then with gathering speed, over years that feel like stability until they suddenly don't. Every single day, 10,000 Americans turn 65. This will continue every single day until 2030. These people already exist. They're already aging. The wave is not a forecast. It is a demographic fact inscribed in birth records from the late 1940s and 1950s. Now arriving at the Social Security window with the mechanical certainty of a calendar turning, the American fertility rate in 2024 stands at 1.62, the lowest in recorded national history. Lower than during the Great Depression. Implications are direct. Fewer births today mean fewer workers 20 years from now, mean fewer payroll tax contributions, mean a wider gap between what Social Security promises and what it can pay. The Medicare fiscal threat is, if anything, larger. Current projections show Medicare spending doubling from $900 billion in 2024 to over $1.8 trillion by 2035. The Medicare Hospital Insurance Trust Fund is projected to reach insolvency before the Social Security Trust Fund. The simultaneous exhaustion of both programs' reserves is an event for which American institutions have no plan and no precedent. Meanwhile, more than 20 state pension funds, covering teachers, firefighters, police officers, municipal workers, are critically underfunded. Illinois is funded at 44 cents of every dollar it has promised. New Jersey, at 38 cents. These are not accounting abstractions. They are future benefit cuts waiting to be announced. Post-World War II Japan offers the clearest precedent for where demographic deterioration leads. In 1990, Japan's asset bubble collapsed. What followed was not simply a financial crisis. It was the unmasking of a demographic reality that had been building for decades, society aging faster than any other developed economy. With a workforce shrinking relative to its retiree population and a political system that responded to the impossible arithmetic of entitlement promises, the same way political systems always do. It borrowed and kept borrowing. Japan's national debt today stands at approximately 260% of GDP. Its central bank owns more than half of all outstanding Japanese government bonds. Interest rates have been held near zero for 3 decades. The Japanese workers who trusted government bonds across that entire period have experienced essentially zero real return on their savings for 30 years. This is not collapse. It is something equally devastating, permanent stasis. An entire generation's savings not destroyed in a single catastrophe, but slowly, methodically, mathematically neutralized. There is a darker lesson in the history of what happens when the productive class of a society is removed faster than institutions can adapt. In August 1972, Idi Amin expelled approximately 70,000 Asians from Uganda, a community that, despite representing less than 1% of the population, operated roughly 90% of Uganda's businesses and generated a disproportionate share of its tax revenue. The Ugandan economy did not gradually adjust, collapsed. Within 2 years, GDP had fallen by more than 40%. The institutions that had depended on that productive base, including whatever rudimentary pension and social benefit systems existed, had no revenue foundation remaining. The lesson is not about ethnicity, it is about arithmetic. When the productive base of an economy, the workers, the contributors, the taxpayers shrinks faster than the dependent population it supports, institutions that seemed permanent become instantly unsustainable. In America, the productive base is not being expelled. It is aging, retiring, shifting from the contributing side of the ledger to the drawing side. The effect on the fiscal arithmetic is the same. And the institutions built to manage that arithmetic were not designed for this ratio. They were designed for a ratio that no longer exists. The danger of the next 3 years is not any single crisis. It is convergence. Individual financial events, a debt ceiling standoff, a regional banking stress, an inflation spike are manageable when they arrive in isolation. The political system can respond. The Federal Reserve can intervene. Emergency mechanisms can be deployed. What has never been adequately stress-tested is the simultaneous arrival of multiple serious stresses into a system that has already spent most of its emergency capacity. In September 2007, customers of Northern Rock, a British mortgage lender, formed queues outside branches that stretched around the block. They had seen the news. The bank had sought emergency liquidity from the Bank of England. In the modern era of deposit insurance and sophisticated financial regulation, a bank run was supposed to be a relic of a pre-New Deal past. It wasn't. Northern Rock was nationalized within months. Its collapse was not caused by fraud or reckless speculation in the traditional sense. It was caused by an institution that had made assumptions about the continued availability of short-term funding, assumptions that were reasonable individually. In isolation, until suddenly every assumption stopped being true at the same time, simultaneous assumption failure. That is the anatomy of a cascade. The 5 convergent triggers of 2026 to 2028. 1. The debt ceiling will be breached again. At a debt level of $40 trillion, in a political environment at least as fractured as 2023's near default. The bond market's patience for congressional brinkmanship at this debt level is finite. It has already been spent twice. 2. The Federal Reserve's rate-cutting cycle risks being interrupted by re-accelerating inflation in 2026 to 2027. If the Fed must reverse course, raising rates back into an economy and a federal budget that's dependent on cheaper money, the consequences include both recession risk and debt service cost explosion. 3. Approximately $2 trillion in commercial real estate loans mature between 2025 and 2028. Office vacancy rates in major American cities remain at generational highs. These loans cannot be repaid at original valuations. Defaults flow to regional bank balance sheets. Bank stress flows to credit availability. Credit tightening flows to economic slowdown. Economic slowdown flows to reduced tax revenue. Reduced tax revenue flows to wider deficits. 4. Social Security peak claims arrive in 2028. As the largest Umair cohorts hit maximum claiming age simultaneously with a trust fund that has been drawn down for consecutive years. 5. It is an election year. Congress does not restructure entitlement programs in election years. The political incentive to promise more and cut nothing dominates every other consideration. The MF Global collapse of October 2011 is a small but instructive case study in how protection mechanisms that people trust completely can fail completely. MF Global was a regulated futures brokerage. Its customer accounts were segregated legally by regulation, by every protection the financial system offered. Those accounts were supposed to be untouchable regardless of what happened to the firm. When MF Global failed, $1.6 billion in customer funds were missing. Funds that customers had been told were safe. Funds that the regulatory framework explicitly protected. They had not been stolen in any simple sense. They had been moved through a series of internal transactions that were each individually, arguably within legal parameters, until the firm collapsed and the money was simply gone. Customers who had done everything right, chosen a regulated institution, maintained segregated accounts, followed every rule, lost money they had been guaranteed they could not lose. Protection mechanisms work until they don't. Guarantees hold until they can't. The entire architecture of American retirement security, Social Security, pension funds, FDIC-insured deposits, 401k, regulation, is a system of protection mechanisms built on the assumption that the underlying fiscal reality can support them. That assumption is now the question. The template for how governments break promises to retirees without ever formally announcing that they are doing so has been refined across centuries. But two recent cases, one from Southern Africa, one from the Middle East, illustrate the mechanism with a clarity that requires no historical distance to understand. In Zimbabwe, between 2007 and 2009, the government of Robert Mugabe presided over what became the second most severe hyperinflationary episode in recorded history. Annual inflation reached 89.7 sextillion% in November 2008. The Reserve Bank of Zimbabwe issued a $100 trillion note, not as satire, not as a collector's item, but as a functional denomination intended for actual transactions in an economy where a loaf of bread cost billions of dollars. Zimbabwean civil servants and teachers who had contributed to the National Pension Fund throughout their careers received their pension payments faithfully, on schedule, in full, in Zimbabwean dollars that had ceased to have any meaningful exchange value. The government never formally cut their pensions. The checks arrived, the payments were made. What was not made, what could not be made, was the value those payments were supposed to represent. A retired Zimbabwean school teacher in 2008 received her monthly pension. She took it to the market. She could buy 2 eggs. Last month, the same payment had bought a week's food. The month before that, a month's food. The nominal amount on the check was unchanged. The real value had been inflated into near nothingness through the deliberate, systematic expansion of the money supply to cover government obligations that taxation could not fund. The promise was technically kept. The value was completely destroyed. This distinction between nominal fulfillment and real default is the most important concept in understanding what is coming for American retirees. When analysts say the Social Security system will not formally default, they are technically correct. Checks will continue to arrive. Deposits will continue to be made. The nominal amount may even increase with cost of living adjustments. What they are not saying, what the historical record demands be said, is that nominal fulfillment and real value are not the same thing. A check that arrives on time but purchases 30% less than it purchased 5 years ago is not the promise that was made. It is the administrative performance of a promise whose substance has been quietly removed. In Lebanon, the collapse happened faster. Well, the mechanism was identical. Through 2019 and 2020, Lebanese banks, with the explicit encouragement and guarantee of the Lebanese state, had been paying depositors. Interest rates of 15% or more on dollar-denominated accounts, the rates were extraordinary, irreflected for those willing to see it. System in severe distress, paying above-market rates to attract the capital it needed to function. In October 2019, protests erupted, banks closed. When they reopened, accounts were subject to informal capital controls that became formal restrictions. Lebanese depositors with dollar accounts explicitly denominated in US dollars, explicitly guaranteed by Lebanese. Banking regulations discovered that those dollars could only be withdrawn in Lebanese pounds at an official exchange rate that bore no relationship to the actual market rate. A Lebanese retiree with $100,000 in a dollar account could withdraw the equivalent. In pounds of approximately $15,000 at market rates, 75% of their savings had not been confiscated. It had been administratively redefined out of existence. The government had not stolen the money. It had changed the rules governing the money until the money meant something different from what it had meant when it was deposited. This is the playbook. It has always been the playbook. In the year 1453, the Byzantine Empire, the eastern successor to Rome, which had persisted for 1,000 years after the Western Empire's fall, ceased to exist when Ottoman forces breached the walls of Constantinople. But the end did not begin in 1453. It began generations earlier, with a sequence of decisions that were each individually defensible, even necessary, but that collectively hollowed out the fiscal and demographic foundations of an empire that still looked from the outside like a going concern. The Byzantine gold coin, the solidus, had been the most stable currency in the world for 7 centuries. Merchants from London to Beijing accepted it. Its gold content was fixed, guaranteed, trusted. Then, beginning in the 11th century, successive emperors facing military pressures and fiscal shortfalls began reducing the gold content, not dramatically, not all at once, incrementally, a few percentage points at a time, enough to fund the next campaign, enough to cover the next shortfall, enough to defer the reckoning one more year. By the 12th century, the solidus had lost more than 80% of its gold content. Byzantine merchants and retirees who held savings in solidus coins, who had built financial plans around a currency that had been reliable for hundreds of years, found that the foundation of those plans had been quietly removed. Coin by coin, emperor by emperor, year by year, the Byzantine Empire did not fall because it lost a battle in 1453. It fell because it had spent 2 centuries making decisions that prioritized short-term survival over long-term structural integrity. The 1453 defeat was not the cause. It was the confirmation. The United States faces 3 possible paths through the 2026 to 2028 window and beyond. The first is structural reform, genuine. Legislated adjustment to Social Security's retirement age, benefit formulas, and funding mechanisms. Economically optimal. Politically nearly impossible in the current environment. The window for this path has been narrowing for 40 years. The second is inflationary erasure, maintaining nominal benefits while the purchasing power of those benefits is systematically reduced through monetary expansion and currency debasement. Politically survivable. Economically devastating to everyone holding dollar-denominated savings, the path of least resistance, the path that history selects most frequently. The third is system failure, a debt ceiling crisis, bond market dislocation, or trust fund exhaustion, triggering emergency measures that result in abrupt, unplanned benefit restructuring. Politically catastrophic, economically unpredictable. Less probable than the second path, but less improbable than most people currently believe. History is not ambiguous about which path governments choose when all 3 are technically available. They choose the second, always, because it is the only path that does not require elected officials to stand before voters and say, plainly, that the promises made to them will not be kept. Inflation keeps the promises, simply destroys what the promises are worth. There is a question that appears in some form in almost every account of people who lived through the collapse of a financial system they trusted. It is not, why didn't I see this coming? The answer to that question is usually available in retrospect. The signs were there, the data was public, the warnings were made. The question is not visibility, it is psychology. Human beings and the political systems they create are profoundly, consistently, structurally resistant to acting on long-term threats that have not yet become immediate crises. The real question, the one that recurs across accounts from Argentine retirees in 2001, from Zimbabwean civil servants in 2008, from Lebanese depositors in 2019, is this: how do we let it get this far? The answer is always the same. Not corruption alone. It's not incompetence alone. Something more fundamental. The people who made the decisions that created the crisis were rarely the people who would live with the consequences. The cost and the decision were separated by time. And across that time, every political incentive pointed toward deferral. Social Security's mathematical problems have been documented since the 1980s. The demographic challenge has been visible since the 1970s. The debt spiral has been measurable since the early 2000s. The reserve currency erosion has been trackable since 2010. None of it was hidden. All of it was deferred. The Byzantine emperors who debased the solidists were not stupid men. They understood what they were doing. It made the calculation that the empire's immediate survival required choices that would damage its long-term foundations. And they made those choices and handed the consequences to their successors. The successors did the same, and their successors. Until the empire that had endured 1,000 years ended not with a defense, but with an emptied treasury. A debased currency, and walls that looked solid until the moment they didn't. The Social Security checks will keep coming. The deposits will keep arriving.
The government will keep saying the system is secure.
Watch the purchasing power, not the number on the check. Oh, what the check buys, because that is where the real promise lives. And that is what is quietly, legally, historically being taken away. Not today, not in a single moment of obvious betrayal. Gradually, then faster, then all at once.